Microsoft went on this market this morning. Good morning to you. Equities down, going into the open by 1.1% on the S&P 500. On the Nasdaq, down by 1.66%. More tech earnings after the close. Looking ahead to Tesla, going into the open. Futures looking soft here on the Russell. We're down 0.8%. There's the opening bell. Switch at the board and get to the bond market. Yields shaping up as follows, going into GDP and jobless claims tomorrow morning. On the 10-year, 354.07, yields unchanged on the 10-year this morning. Euro dollar not doing much off the back of better than expected German business confidence, 108.84 on euro dollar. And crude just about holding on to $80 and about 36 cents, positive there by almost a third of 1%. That's the cross-asset price action about 20 seconds into this one. Equities lower by more than 1% on the S&P, on the Nasdaq down by 1.6. These stocks to watch at the open. It's Microsoft, the company delivering a bit of a grim outlook. The CFO, Amy Hood, saying the following: we are seeing customers exercise caution in this environment, and we saw results weaken through December. We expect third quarter growth to decelerate. And Abby, it's that word decelerate that gets our attention.
Yeah, it certainly does. It's getting the stock's attention for sure. And it's interesting, John, because yesterday in the initial reaction to this stock, the report, we had the shares higher on that cloud business. But then as details were given, especially that growth, we now see the shares down, the worst day since January 4th of this year. And you can see here that the last quarter, 38% year-over-year growth. Initially, investors took that as a good thing, but it's that outlook for this current quarter of 33%. If you take a look at that relative to 48% growth in September of 2021, a 15% deceleration. Now, it's interesting because Satya Nadella, the CEO back last week at Davos, was talking about the idea that there's a normalization out of the pandemic. The question is, what growth number will investors think is acceptable? This, of course, has weighed on revenues overall. We're looking at the slowest revenue growth for Microsoft going back to 2016, growth of just about 2%. Nonetheless, it's not deceleration, so that may be a positive thing. It's not just about revenues, though, John, too. We have an issue around profits. The EBITDA margin slid. It's down more than 7% from its September 2021 levels, so we're seeing some issues there. Technically, the stock, though, John, it's interesting from a long-term perspective, looks as though it could have found some sort of a bottom. We'll, of course, find out. But when you take a look at valuation, 23 times next year, more than 30% bottom line growth for managers who have to own tech. At some point, this may be a stock that they're going to look at. Not exactly a kitchen sink quarter here, but enough bad news may be out of the way that you'll see some folks nibble, maybe even later today, John.
Stock's down 3%, a little bit more than that, about 2 minutes into this. Abby, thank you. Broader market down by 1.2% on the Nasdaq, down by almost 2 percentage points. Texas Instruments delivering a similar script. The chip maker failing to provide investors with any clarity on sales. The CFO had this to say: arms in the air, I wish I knew. Customers have done what they've done for decades. They've built a little too much inventory. We'll see how long that takes to work itself out. For more, here's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, it's no surprise that one of the largest chip makers in the world is feeling the chip slump in a big way. They actually reported their first decline in sales going back to 2020, a decline of about 3.4% for revenue, even though that did come in ahead of expectations. And for the quarter they just reported, profit came in ahead of expectations too. But when it comes to their guidance at the midpoint of the range they gave, both the top and bottom line came up short of analyst expectations. The basics here, John, is that Texas Instruments may have the broadest range of products in the industry and the longest list of customers in the industry, but that doesn't matter so much when those customers aren't demanding as many of those products. Instead of ordering new chips, they're focused on reducing their stockpiles of used ones because they have too much. This is a very common post-pandemic story. So that has led to weaker end demand for Texas Instruments in almost all of its end markets, the exception being automotive, which is about 21% of its revenue share, but everything else, they said, was down between 10 and 20%. One analyst over at BMO this morning said it's only a matter of time before there's weakness in automotive as well. At Citi, they're talking about broadening weakness, saying it appears gross margins could drop another 200 basis points quarter on quarter. What I do find interesting on that point, though, John, is despite those pressures, Texas Instruments executives say they aren't planning to reduce headcount in order to cut costs. The reason why, the CFO says, because the company didn't get ahead of itself and hire a lot of people over the past 2 years. Their headcount has actually stayed remarkably steady, so that is something that differentiates them from the other technology-oriented companies that we are seeing with layoff announcements almost each and every day, John.
That's a bit of shade. Everybody else, it seems, over in tech. Kaylee, as you say, Kaylee, thank you. That stock is down 1.3%. Tesla a lead in the next round of tech earnings. Those results coming after the closing bell as investors' concerns keep piling up. Ed has more. Hey, Ed.
Yeah, good morning again, Jonathan. Well, we see the stock lower 1.9%. Both JP Morgan and Morgan Stanley cut their price targets on the stock ahead of earnings, basically saying that they're looking at those price cuts, particularly in China, and what that will do, not necessarily as a lever and driver of demand, but what it means for profit going forward. Analysts expect adjusted earnings of $1.12 per share on $24 billion of revenue. That would represent sequential and year-on-year growth, but they go straight to gross margin, right? Tesla is kind of the industry leader when it comes to gross margin, which analysts expect to come in at 25%. What does the impact of those price cuts do to that gross margin? You know, remember Elon Musk has talked quite recently on a Twitter Spaces on the issue of demand, and you know, I'm paraphrasing, but his question that he posed was, do you want us to demonstrate unit growth and use price cuts as a way to drive volume growth, or do you want to grow slowly and steady? His conclusion would be that Tesla should grow as fast as they can without putting the company at risk. What I would say when it comes to Tesla's quarterly earnings, Zach Kirkhorn, the CFO, tends to step up, give granularity about what Tesla is doing with regards to the supply chain, the management around the bottom line. Sources have been telling me recently, go back to that last quarter of deliveries. Internally, there's still frustration over the number of vehicles that were in transit, therefore not delivered to customers, and therefore not booked as revenue. So that's still an issue we're going to be monitoring for as well.
Just quickly, some clarity. You touched on it a little bit. Are we going to hear from Elon later?
I believe we will. You know, the context here, Jonathan, is that Elon Musk has told investors in the past that he doesn't believe he needs to attend earnings calls and that there are better uses of his time. But following those statements made 18 months ago, he has continued to attend the earnings calls. He has been in San Francisco courthouse, of course, this week around the 2018 Take Tesla Private tweet hearing, which is a jury trial. And he then flew to Nevada 24 hours ago for the announcement of a $3.6 billion expansion of their facilities there. So there's nothing that tells us he won't be on the call, I don't believe.
Looking forward to your coverage a little bit later. Ed, on the West Coast, on top of Tesla. Oppenheimer's Colin Rush looking ahead to Tesla results and saying the following. The core issue is whether the company can continue to grow while maintaining premium margins. We anticipate mixed trading on shares as EV competition begins to play out and expect updated margins to be modestly better than feared. I'm pleased to say that Colin joins us right now. Colin, let's start there. The price cuts, and thank you for being with us, by the way. The price cuts of the last couple of weeks, are they a bigger problem for Tesla or their competition?
I really think this is a proactive move on Tesla's part to make it very difficult for their competition to ramp. You know, they have a structural cost advantage because they've designed cost out of the vehicles, and they've got a volume advantage. We think they're pressing that advantage now to make it pretty painful for competition. And I think the real question for investors right now is what's the normalized margin going forward through 2023? I think the strategy that they're looking at is coherent, and there's a lot of investor concern around competition here. But what the normalized margin and cash flow looks like for this company, through 23 and 24 as we go through this adjustment period of actually having competition for the first time is really the heart of the matter for the stock.
Colin, what do you think it is?
You know, I think it's going to be a little bit better than feared. We think there's some folks betting on, margins being in the low 20s for 2023. I think with the commodity tailwinds, some of the supply chain things that you were just talking about on the program with components becoming more available, plus some of the, the sell-through and utilization on the new factories, point to margins being a little bit better than feared. And I'm not sure we're going to get to the street's at 26.5% right now. I'm not sure we're going to get all the way there from a gross margin perspective. But if we're in the 24-25% range, I think the stock rallies from here.
Colin, given what's happened with price, has that changed your view on what you think the growth numbers are going to look like for the time being, going out several years?
I don't know. So there's a lot going on here. I mean, obviously, Elon's brand has taken a big hit with the Twitter acquisition and some of the behavior around that. We downgraded in December around just the rounding error or the incremental customer being a little bit more cautious around buying a Tesla just from a brand perspective, and that can start to shave some of the pricing power that the company has. And so, as we look at this, there's certainly demand for EVs. We think there's a very big market. There's an awful lot of consumer interest. the total cost of ownership advantages, both in the U.S. and Europe, are still pretty meaningful. And so we think there's sell-through at the right price, but I think people are being a little bit more cautious with the, potential recession. We've got a lot of layoffs and, really, pretty decent jobs where folks could be looking at a premium vehicle purchase. And so I think this year is an adjustment year. We're going to find out kind of where the levels are as we get into the first half of the year and what this looks like. The other thing to consider is really the China demand. We've gone through a change in the subsidy regime in China. That adjustment is starting to be felt from an inventory perspective. There's also a little bit of a slow start to the year with the Lunar New Year being early and some of the reopening. And so there's some inventory flush that needs to happen on vehicles and batteries in China in the first quarter here. And as we get into the latter part of February and into March, we'll get a better feel for how the year is going to progress in China. And that will matter for Tesla from a unit perspective.
There's also, Colin, the valuation issue as well. Rates have gone to 450 at the Federal Reserve. That makes a monster difference for companies like this. And Colin, I'm just wondering from your perspective, how one should value this company. I know what the bulls think. It's a tech firm. I know what the bears think. It's just another auto company. What do you think?
Yeah, we've been firmly in the tech company camp for a very long time. We think that these guys are cycling technology well in advance of peers. They're innovating on the material side, both at the battery level as well as the vehicle level, structurally on the cars as well as in the powertrain. But additionally, around the perception and the navigation system, we think they've got real significant advantages around miles driven and learning cycles on that. And so we think you deserve a premium multiple here. What we're concerned about is the adjustment of the auto industry and Tesla's place in it and potential distraction for management. What you were talking about, Elon being on the call tonight, we would expect him to be here. I think he needs to show that he's attending to what's going on at Tesla and isn't distracted by a number of other things that he has going on on his personal plate. And so I think he'll attend and be very full-throated about the positioning that Tesla's at or has and how they're approaching the market strategically. And so we think that ultimately there is going to be a premium as we look at where rates end up and what multiples really are appropriate given the interest rate environment. We'll come back to that. Right now we don't have a price target given our perform rating, but we think there is a premium multiple and a tech multiple that is appropriate for this company as we get a better sense of what the earnings power really looks like.
Colin, just finally, there was some chatter about capital returns. What do you think that looks like this year, if at all?
I don't think they're going to do, any sort of dividend, return to investors at this point. There are so many opportunities for them to invest cash. We think that they will take those opportunities to grow the business and accelerate some of the cost reductions within the platform. And at some point, they may think about dividending cash out. But I think there's too many opportunities for them to invest right now to really think legitimately about a dividend.
Colin, this was thoughtful stuff, as always. Colin Rusch there of Oppenheimer on Tesla. The numbers coming up after the close. Coming up on this program next, President Biden eyeing a top Fed official to run his economic council.
Policy is going to need to remain sufficiently restrictive for some time to make sure it gets down 2% on a sustained basis.
That conversation up next.
That said, inflation remains high, and policy is going to need to remain sufficiently restrictive for some time to make sure it gets down to 2% on a sustained basis.
President Biden looking to add the Fed's vice chair to his team. Bloomberg reporting Lael Brainard is a top contender to become the new head of the National Economic Council. On top of that story, Bloomberg's Anne-Marie down in D.C. AMH, walk us through what you've learned this morning.
Well, John, what we know now is that she is not just in the running, but a top contender, as you mentioned, to take on the job of the director of the National Economic Council. We should note no decisions have been made, and there are other names that have been thrown around, like Gene Sperling, like Wally Adeyemo. But right now, what you potentially could see in the coming weeks is that the Fed's number 2 becomes the number 1 economic voice in the West Wing. This is on top of a little bit of a shakeup at the White House, which is pretty much natural when you have, after a midterm election and 2 years of an administration. We do know that Ron Klain will also be exiting, and as well as Brian Deese, and that's why Lael Brainard's name is getting a lot of attention this morning. But Jonathan, no one is walking out the door before the State of the Union on February 7th.
MH, great reporting, as always, on the ground down in Washington, D.C. I just want to squeeze this in, Anne-Marie, just briefly if we can. It's an important question about the tanks that Ukraine is finally receiving. Anne-Marie, your view on that, is that an escalation? 6 months ago, would this have happened?
It would not happen 6 months ago, but when you talk to the Ukrainians, and I recently talked to an official that advises the defense ministry, he says that this has always been the way it was working with the West. They would drag their feet, in their words, but then they would come to the realization that this is what is needed on the ground. And for Germany to act, they're acting alongside the United States. Russia will move any move as an escalation, but if they're going to act together, Germany feels much more comfortable sending those Leopards, and the U.S. will be sending their tanks as well.
Anne-Marie, great work down in D.C. Joining us now is DWS Group's Greg Staples. Greg, I just want to touch on the story that AMH went through a little bit earlier on the Vice Chair of the Federal Reserve in line to move towards the administration. No idea if that actually materializes or not, Greg. Would that leave a big hole on the Federal Reserve Board for you?
I think it would leave a little bit of a hole. I think, of course, what's going on right now is you float a lot of names and you get some sort of political reaction. I think it's the reaction to the floating of names that ultimately determines whether Lael Brainard or Gene Sperling or somebody else takes that role. It's a bit of a strange step for her. I'm surprised that they're doing it, but I think the Fed would manage. There's certainly a lot of qualified candidates that could take that spot if she decided to move.
Let's pick up on the commentary of Lael Brainard, the Fed Vice Chair. She's talking about the cumulative tightening, the bill, so to speak, for the tightening that's already in the pie. Can we talk about that just a little bit? There's two competing forces right now, Greg. On the one side, you've got sub-50 PMIs. On the other side, you've got jobless claims of 190,000. What do you put more weight on?
Right now, I think we probably put the weight on the jobless claims. I mean, ultimately, there's really a lot of consensus about where we end up, say, in 2024. Both the Summary of Economics projections and the forward markets are saying we're going to get Fed funds down to 3%. It's really just a battle about the trajectory, whether that happens with a pivot beginning in June, July, or the Fed's put a lot of credibility on saying they're not going to do that until 2024. We're a believer more in the Fed, thinking that they'd like to get to 4 3/4 to 5, do that perhaps in the March meeting. May is still open, and then really sit tight for 2 or 3 quarters. They've put a lot of credibility on the line on that, and I think they have to push it through.
Just on the labour market, you said don't confuse tech layoffs with softer labour markets. Why is that, Greg?
There's still a lot of demand, I think, in the Main Street part of America, whether it be services, your barbers, your garbage collectors, your landscape people. Corporate America is obviously laying off, but it's been limited so far. I think a lot of the tech workers are going to be able to find jobs elsewhere. And I also think that it's really hitting the bottom now, that corporate America has really been very well prepared for this recession. This is the most well-signaled recession we've ever had, if indeed we have it. This is the first time we've actually had a recovery in the markets before the recession that seems to be associated with it has even begun. So I think there's limited downside to that degree. I think corporate is still hoarding their workers to some degree. So I don't see a lot of downside in terms of the labor markets, at least over the next 3 to 6 months.
With that in mind, Greg, shouldn't you be super long the credit market?
we're fairly comfortable with the credit market overall, as strange as that sounds. Things have richened a lot since the beginning of the year. We're in 20 to 25 basis points in IG, over 100 since October, and high yield. They're pretty much priced the way they've been on average over the past 10 years. We don't see the kind of recession that's going to really gap out spreads overall. We've seen a lot of strength within the past month or so, and think that will probably continue. It goes back to what I was saying before. Corporate America, their financial health is quite strong. We're going to see a little bit of caution in the guidance as we see earnings coming through over the next week or two or three, but nobody's signaling a deep recession, and I think they're quite well prepared for the storm if indeed it comes.
Can I finish with this call from Citi in the last 24 hours, Greg, and get your reaction to it? Citigroup said this, the Triple C spree, that was the title of this note. We flip our rating for regular weight Triple Cs to overweight due to light investor positioning, loosening financial conditions, and the shifting composition of the segment away from cyclical sectors. Greg, how do you react to that?
I tend to agree. I think the Triple Cs have had a remarkable rally since the beginning of the year. I think a lot of it's just a risk grab. If you need to get risk in the high yield space, of course, that's where you want to go. But that area, I think, is the one that's going to be most vulnerable if indeed we get some slowing. Obviously, increase in interest rates for floating rate debt is going to cause some problems there. It's really not going to be, I would call, broadly across the Triple Cs. It's more idiosyncratic, but there are going to be some names that are going to suffer, and you have to really pick your spots very, very carefully within that very vulnerable space.
Greg Staples at DWS, the first couple of weeks felt like a risk grab. Not right now. Greg, thank you. Right now, about 22 minutes into this session, we're lower by 1.2% on the S&P. On the Nasdaq, we're down by 1.8%. To lift the lid on the index, to get you some sector price action, here's Abby.
Hey, John. Well, yes, it's certainly a down day here. That S&P 500, as you mentioned, down 1.2% on above average volume, too, suggesting the sellers right now are serious about their selling. Up top, we have healthcare, defensive sector outperforming. Staples up there as well. On bottom, though, not surprisingly, it's all about technology. Microsoft right now near session lows, down 4%. Technology, therefore, is down 2%. Some of the other big techs, such as Apple, Amazon, Google, Tesla, selling off in sympathy with that quarter and that cloud guide. We also have Texas Instruments near session lows, down 2%, dragging. Let's stick with the chips, because, of course, we have this huge rally for the chips out of what could be an October low, up more than 40%. But over the last year or so, John, 13 months, down 29%. The question is that sideways trend that is developing. That's a real battle between the bulls and the bears. As for what's ahead, what direction will it break? Up or down? We don't know yet, but right now we do have the stocks down with the broader markets.
The broader markets right now down too, as you indicate, Abby. Thank you. We're down by 1.2% on the S&P, on the Nasdaq down by about 2 percentage points. Up next on this program, your trading diary. Not a fantastic start to the morning, that's for sure. For the equity bulls at least. On the S&P we're down by 1.3%. On the Nasdaq we're down by more than 2 percentage points. Microsoft helping to lead the losses here in the early part of the session at least. Let's get a trading diary for you. A rate decision from the Bank of Canada coming up at the top of the hour. President Biden discussing support for Ukraine at noon Eastern. Look out for that. Plus earnings from Tesla and IBM after the close. US fourth quarter GDP and another round of jobless claims coming up on Thursday. And finally, PCE numbers and the UMich sentiment survey to round out the week on Friday. From the City of London, that does it for me. For our audience worldwide, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, January 25th. Here are the top market stories that we're following for you at this hour. A bust for Boeing. Stock falls. Revenue misses estimates as high costs dent a recovery. We're going to get the read from the skies with United Airlines CEO Scott Kirby. And finding direction. Earnings versus the Fed. You got stocks sink as big tech drags down equities. What's leading the market? Is it the macro or the micro? And the West rolls in tanks. Germany will send tanks to Ukraine, and the U.S. is set to follow in a big step in the country's fight against Russia. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, this is shaping up to be a really ugly day and raises questions as to what's in the price ahead of earnings and what do you get so punished for?
Yeah, I think we're learning that you get punished very quickly. Certainly that seems to be the narrative thus far. It's interesting that Boeing actually isn't falling more than it is at the moment. Bank of Canada is, I think, an interesting little interlude here, Alex, because in some ways there is an expectation that central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go. The Bank of Canada beginning to signal that it's getting towards the end of its rate hiking cycle, and I think this is something that the market is going to want to pay attention to. Is this an early indicator as to where other central banks potentially could be going, the Fed, Bank of England, etc. So the Bank of England has raised by 25 basis points, and that's pretty much in line with expectations. But here's the twist. The Bank of Canada now expects to hold rates while it assesses the impact that the hikes that it's delivered thus far are having. The Canadian currency, the loonie, erasing gains after this policy rate decision. This is I guess you could call it a hawkish hike, but with a dovish message. Maybe it's just an inline hike. But nevertheless, I think a lot of people are going to be looking at this and saying, is this what we get next from the Fed?
Yeah. Well, also, when they're still looking at their average inflation forecast for this year, it's still in the threes. It's still going to be 3.6%. So they're not done with the inflation story. And then you take a look at what happened in Australia. You can see inflation can accelerate, something we learned overnight.
Well, I think that is what these central banks are going to be looking for.
Yeah.
And they're going to try and work out, because they've got a lot in train, what impact is it going to have? This long and variable lags thing, I think, is being called into question right now.
Yeah, let's get more on this. Bloomberg's Michael McKee joins us to break down the numbers. All right, what do you make from this? How does it set up the Fed for next week, Mike?
I don't think it really has an impact on the Fed. Their situations are similar but somewhat different. In Canada, they have had a major collapse in home prices because a lot of Canadians have adjustable rate mortgages. And so the higher the Bank of Canada goes, the more it hurts the housing industry there. And that's one major difference from the U.S. The inflation rate has really dropped in recent months, specifically the headline number, but even the core starting to come down, and you can see where they are with the headline target rate. And so they can take a pause, but that, as they make very clear, is not a certainty that this is the end. They just want to make sure they see what happens to the economy afterwards. The Fed doesn't have the real estate situation, but they do want to see what's happening with the economy.
But this is the narrative, isn't it, that all central banks are grappling with at the moment, Mike, is that they've done a lot and they've done it relatively quickly, and they don't know whether the impact of that policy shift is being affected now, how much more is still to come. And this is the real challenge, I think, for the Fed. We're now in calibration mode, and that's the difficult bit. It's the finessing bit that is going to be the real challenge.
Yeah, it's the old question of how long are the long and variable lags. Fed officials have said they're expecting the full force of what they've done so far to only start hitting the economy this spring. So it is a possibility that they have already over-tightened. They don't think so, but that's why you get these arguments on Wall Street about what they should be doing.
Okay, let's widen this out and try and assess kind of where we go next and which is going to be the prime driver for markets around the world, for asset prices. So our question of the day goes something like this. Is this now a top-down market, i.e. a macro market, i.e. we're going to focus on things like the Bank of Canada, or is it a bottom-up market? Should we be focusing on Boeing and Microsoft? Where is the message that investors should be listening to here? Mike's already here. Let's bring into the conversation Jess Menton. Jess, what is your take on this? We're into earnings season. Is it still a macro market, or do you think the bottom-up approach is now going to be the best way of assessing future direction?
It seems as if investors are really moving more toward what the earnings are saying about the companies as well as their outlook. So when you think back to last year, most of things were being driven more on the macro sense in the data. But when you look at the last few CPI reports, the market may have initially jumped higher pre-market, but by the time the market actually closed, you didn't see the same type of gyrations that you would have had seen most of last year. And we're seeing that with some of the other economic data. And a lot of this at times can obviously be more backward looking. Obviously, we have fourth quarter GDP, that initial take on Thursday, but some people are actually looking ahead to next Tuesday's report for the employment cost index. index. That's something that Fed Chair Jerome Powell had actually flagged at the December 2021 meeting, just a couple weeks after he had actually dropped transitory. So that's something that has been had hovered at a record at the beginning of last year, has eased a little bit off there, but economists are thinking it might stay about in line around 1.2%, but still that's really high there. And still, as far as how you're measuring that for wages and wage growth. But again, when you're looking at what's happening coming into this week, if you looked at Bloomberg Intelligence data, companies had actually been rewarded more so and had been beating a 6-year average when you were looking at if they were beating on EPS and sales. But obviously this week and next week was such a key focus with the majority of technology and growth companies reporting. And you're seeing bigger swings now as far as how these companies are reporting. So a lot of my sources are arguing it's a bit more seeing as far as what's happening with the micro than more so on the macro right now.
Well, also then sort of stocks kind of running into their earnings like Microsoft, for example. So in that sense, it's no surprise that they wind up falling when they were at their 50-day moving average as of yesterday. And like to this point, I was talking to an FX person yesterday and he's like, I don't talk about the Fed anymore. I only talk about commodities. True story, quote unquote. This put you out of a job now.
Well, I think at this point, a lot of people are watching commodities because we're starting to see a turn for various reasons. China is the main story behind it that everybody's looking at. And then it's a question of how much does that feed into future inflation problems?
Gasoline prices on the rise, for example.
Gasoline prices on the rise. That's a political problem for the president. But is it a problem for the Fed because they can't do anything about it? If they see the core rate start to come down, that's going to be probably good enough for them to halt at around 5%. The question is then how long do they leave it there if inflation remains elevated, because they don't want the gasoline price increases and other commodity price increases to feed into expectations.
Jess, I've got another anecdote for you. It was from Ralph Slotstein the other day, who joined us from Evercore. He was saying that when he talks to individual companies, they sound really positive. But when he asked them about the macro situation, they sound really negative. Are we in danger of listening to the wrong news feed, as it were? We should be listening to companies. They have a better handle on what is happening. They know what's going on with their businesses. They're being a little freaked out by kind of people like us giving them the macro news, which sounds very dire.
Right. So when you're looking at EPS or sales, obviously it's a bit more backward looking, but the big thing is looking at those outlooks from companies. And so far, when you think of a quarter of the market that really got hit hard last year was actually when it came to chip makers. And so that was something that a lot of my sources were going to keep a key eye on to see what they were saying moving forward. Obviously, we heard from Texas Instruments. There were a little bit of a dire warnings there, but still you have a number of other chip makers that are going to come up and report soon. So I think that's going to be key as far as what the trajectory looks like. But another thing on the commodities front, something that's come up in a lot of my conversations with sources is what's happening with copper prices. And when you see copper prices just within the last few weeks topping 9,000, it's hard for them to imagine that there's going to be a global recession when you think of how many components that copper prices go into when you think of the sectors in the S&P 500. So that's something that they've been scratching their heads at as far as when you see what's happening with commodity prices, but then also if that does correspond to this more value type oriented sectors in the S&P 500, that still would drive more value more so than growth. And so what does that mean for the leadership makeup of the S&P 500? Can it really be led by value sectors when you are counting on a bigger composition for the technology and obviously communications services and discretionary to try to drive things higher?
Yeah, no, it's a great point. Hey guys, great setup to the conversation. We super appreciate it. Mike and Jess, thank you both very much. To point out that you're taking a look at the loonie, definitely taking a dive and yields coming lower as well after the Bank of Canada rate decision. So coming up, we're going to talk more about this. Top down or bottom up? We're going to pose the question of the day to Jordan Jackson of JP Morgan Asset Management. Coming up next, NASDAQ 100 off by 2%. This is Bloomberg.
earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money with exclusive expert analysis.
Does this approach make sense to you?
They're going to have to make an acquisition.
It's quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The big thing for this week is really tech earnings.
So the big tech stocks.
Big tech, we saw the start of it last night.
The message we're getting from this particular sector is that growth is slowing.
Microsoft talked about that last night.
Microsoft is talking about a weak global backdrop.
They haven't guided in this release, so we need to hear guidance.
The cost cuts can only get you so far.
No one was going to do backflips over these numbers.
It's all the other companies that have yet to report that have to deliver bad news.
But relative to the fear, way better than expected.
We're continuing this process of reevaluating valuations.
Some of the tech names, have become a lot cheaper than they were.
But I'm not sure that that's going to continue.
The multiples there are still too high.
Let's not break up the champagne glasses at this point.
Those were some of the TV guests weighing in on growth fears as earnings trickle out, which takes us back to the question of the day: is this a top-down market or bottom-up market? Joining us now, Jordan Jackson, JP Morgan Asset Management and Global Market Strategist. If top-down was all about last year, what is it so far this year?
Well, I think it's a bit of both. Obviously, you've got earnings. We're knee-deep in the earnings season, and maybe companies aren't rewarding, markets aren't rewarding companies that are actually beating on earnings. They're really looking for the forward guidance that they're actually presenting. And now, next week, we've got the Fed. Obviously, that's certainly a more macro story, and I think that has the potential to move markets as well. Markets are still trying to figure out if the Fed is potentially at risk to over-tighten and turn the economy into a potentially a deeper recession. Yep. And so I think it's a little bit of both that's driving markets today.
Which do you think, Jordan, good morning, it's Guy, which do you think the market has a better handle on right now? What the Fed's going to do or what earnings are going to do?
That's a tough question. It's been really interesting that the market has not budged really since the start of the year in their Fed expectations, even though you've got, I'd say, tilting more hawkish rhetoric from the Fed in terms of keeping rates or lifting rates to at least 5% and then keeping them there for the balance of the year. Markets still anticipate a peak Fed funds rate of 4.9% reached by May or June of this year, and then rate cuts in the second half. But again, the Fed continues to sort of push back against that. And where I struggle with is, historically, when you look at tightening and loosening cycles, the Fed takes the escalator up, but the elevator down. The challenge last year, the Fed took the elevator up, and I think if the markets Fed futures are pricing in gradual rate cuts, that's more or less a soft landing. But again, if the Fed does too much, they may have to take the elevator down sometime in 2024, given growth potentially could slow more than what's currently is anticipated.
In the meantime, a lot of stuff is head scratching because you get the soft data that we've talked about is weaker. The hard data continues to hold up. And then the markets, with the exception of today, have been holding up really well and have been running into some of these numbers. Just take a look at Microsoft. Does some point the soft data feed through to the earnings at this point, or can we look at them differently?
Well, it's interesting because obviously PMI numbers are in contractionary territory. You look at new orders relative to inventories. That suggests some more slowing in the broader economy. On the other end, inflation continues to show signs that it is coming down. But again, the challenge really is when you look at the forward guidance that companies are providing, it's a very somber outlook. So you think about the investment spending environment amongst companies is likely to be fairly weak. Obviously housing is likely to continue to struggle over the course of this year. And so the strong dollar is going to continue to create a bit of a headwind for our export business. And so growth this year is going to hinge on the consumer. More or less is going to hinge on the health of the labor market. And it's been interesting to see this huge divergence amongst demand for labor amongst small and medium-sized businesses and the large layoffs that we're seeing amongst their larger counterparts.
Okay, so Jordan, this strikes me as being just a question of timing. The labour market is holding up. It is confounding expectations. Companies are not laying staff off in the way that you would normally expect. That's going to be a margin story. That's going to hit margins. But the top line is still going to continue to tick along potentially quite nicely. So which numbers should I be looking at here? Should I be looking at the top line, which is telling me, as you say, that the consumer's looking all right? Or should I be looking at the middle of the P&L, at that margin story?
Well, I think the reality is markets recognize that margins are going to continue to come under pressure. And so I think from an investment perspective, you got to kind of look at the top line and gear yourself towards sectors that have a degree of pricing power. Although inflation is going to come down, it's still high relative to historical standards. And so you're going to want to look at companies that can continue to grow earnings, continue to hit revenue growth in an environment where nominal GDP is certainly going to slow, but still, again, remain fairly elevated as inflation remains pretty high. So again, it all reverts right back down to pricing power amongst companies and sectors.
Okay, let's just finish off with what's happening in tech right now. NASDAQ 100 being really beaten up, down over 2%. What do you do with tech? You sell into weakness?
I think there still may be a little bit more pain to be had. I think valuations still need to come down a little bit more. Certainly, if you get a deeper recession, which is potentially on the horizon, and the Fed that maybe is committed to continue to raise interest rates, that suggests a more somber outlook for tech stocks. And so we continue to lean a little bit more defensive within portfolios. That said, we know markets are forward-looking, and so as we start to look ahead towards 2024, if markets are anticipating a bit of a rebound in growth and potential reversal from the Fed in terms of reducing interest rates, I think that's going to provide a very, very strong rally. And I do think the tech sector and more cyclical parts of the market are going to lead the market coming out of this weakness.
Jordan, it's always great to catch up. Always great to get your views. Thank you very much indeed for sharing them with us. Jordan Jackson of JP Morgan Asset Management. Thank you very much indeed. Coming up, we're going to talk about what is happening with Boeing. The company has just reported its sixth straight money-losing quarter. This is down to a cost issue. Cash flow actually looks pretty good. We're going to talk to an analyst next. He's pretty bullish on the stock. Josh Sullivan of Benchmark joining us next. This is Bloomberg.
time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The New York Stock Exchange blames a manual error for wild price swings and trading halts when the market opened Tuesday. It was linked to what the company calls its disaster recovery configuration at the start of the day. Over 1,300 trades and 84 stocks were affected. AT&T forecast profit and free cash flow for this year that missed estimates. It's another signal that high costs are hurting prospects for the wireless industry. Mobile growth was better than expected, with AT&T adding 650,000 new subscribers. And that is your latest Business Flash, guys.
Ritika, thank you very much indeed. Boeing reporting a surprise loss to end 2022. It's the fourth quarter. It's the company's sixth consecutive loss in a row. The analyst call about starts in a few minutes' time. Josh Sullivan, senior aerospace and defense analyst at Benchmark, joining us now. He's got a buy rating on Boeing. Price target 250. Let's talk about which number, Josh, we should be looking at here. Should we be looking at the margin line or should we be looking at cash flow? Cash flow is what drives these companies, Airbus, Boeing, etc., etc. You need to deliver airplanes, you need to get cash. That line looks better. Costs are going to bounce around a little bit. Is that the basic case here?
Exactly. Yeah, you look at what Boeing started working in November after the Analyst Day, and they hadn't given or provided long-term guidance for several years. And it was really focused on free cash flow generation, as well as giving an outlook for the aircraft delivery cycle. And so what did we get this quarter? We got a slight beat in free cash, and how Boeing's looking at things, that's the target they're going to work towards. As they ramp up production, operational costs are going to move around in Boeing commercial aircraft as they work with the supply chain. But their focus is really on free cash generation, which they exceeded this quarter, and they reaffirmed 23 free cash guidance as well.
So Josh, why is the stock down? I mean, is it simple as like it already had a run? I mean, then what's the big problem here?
Yeah, I mean, the headline on the loss is obviously, part of that. In the defense group, the margin profile is getting better. Last quarter, they took some long-term charges. The margin profile, even excluding that, was relatively flat or zero. And relative to the street expectations on the defense group, we are growing out of that. But the sequential growth wasn't as much as expected. So that was part of it. But really, we see it as an opportunity. We think that, they're doing a little kitchen sinking here at the end of the year. The 23 free cash, we see upside to that as we move through the deliveries.
They're looking to ramp the 737 lines, and I'm wondering how feasible that is. They're clearly way behind where Airbus is going to be in terms of the numbers of narrow bodies that are going to be being produced here. But if you talk to Airbus, they talk about supply chain issues with that ramp. And many of these sort of tier 1, tier 2, tier 3 suppliers are shared. How easy is it going to be for Boeing to make that ramp in narrow bodies?
It's definitely a challenge. I mean, they confirmed the 31 per month on the 737 this morning. There's expectation that they could move to 38 by the second half. Boeing's going to work with the supply chain to ramp up. We had GE and Raytheon yesterday, saying that there was nothing inhibiting their ability to deliver on either one of the OEM's plans. So Boeing has that inventory of 737s that have been parked that gives them a little cushion on what they're actually delivering versus what the supply chain can deliver, which is one of the reasons we do like Boeing. But Boeing's going to work with the supply chain. They're not going to break it. And again, their focus is on free cash, so they can work with that inventory of aircraft as well as moving up the supply chain as necessary.
Hey, Josh, you're going to get on the analyst call in about 6 minutes' time. What's going to be your question then? Because you are bullish, obviously. 250 is a solid price target. What's going to be your question?
Yeah, that 250 price target is based on free cash. And so it's how do we move up to 38? How do we manage the WIP? The 787 program is an important component of that as well. We saw the large order from United late last year. And so as the 787 comes back on, and there's some rework issues that need to be done with that, and how that moves from WIP into delivery, is going to be an important factor on cash generation. And, historically, that's what Boeing's traded on. And so the headline here is obviously kind of ugly as there's some, just some abnormal costs that are digested. But as long as we're moving towards that free cash guidance, $3 to $5 billion next year, $10 billion long term, as long as Boeing can show that they're moving towards that in a, step function way, in a coordinated way, we do believe the operation or operating margin is going to bounce around next year as they manage through the inventory and the supply chain in that WIP. But again, our focus is on free cash. So the question is going to be all around that.
All right, Josh, super appreciated. Josh Sullivan, Senior Aerospace Defense Analyst over at Benchmark. We'll have to let you go to get on that call. Speaking of earnings, Microsoft shares falling after warning on growth. We're going to get details in the startup. You're looking at the NASDAQ 100 off by over 2%. It's a pretty steep loss. Remember, Microsoft had run into earnings. It was right at its 50 and 100-day moving average and getting a bit pummeled today now. This is Bloomberg.
Great questions.
We're about an hour into a pretty ugly trading session. The NASDAQ is up a full 2 percentage points. Abigail Doolittle tracking those moves. Abby?
Yeah, and this is something that we have not seen recently all that much, Alex. We have stocks down on the day. We also have yields down, so bonds are higher, so that does actually make sense relative to stocks being down, suggesting that yields are now suggesting more of a safety play as opposed to rates. But typically when rates are down, that would take the pressure off of stocks, especially the NASDAQ 100, those high-tech valuation companies that look better when yields are in. Now, we'll be taking a look at some of those movers in a moment. First, though, let's take a look at the NASDAQ 100 itself, because unlike the S&P 500, it has not yet, at least, crossed its 200-day moving average. And I say yet because it does seem likely. Here's the downtrend, the bear market that we had last year. Here's the sideways trend that we're seeing forming in most major indexes. Now, the S&P 500 has popped a couple times above its 200-day moving average. The more important point here may be the sideways trend, though, and it's not the sideways trend that matters so much. It represents a battle between the bulls and the bears shares in terms of their uncertainty about the macro factors and the micro factors earnings, but what way it breaks. There's more indications to think that this range could break to the upside, which could mean that this year's rally will extend, even though it's not happening today. The reason it's not happening today, let's take a look at some of these movers. We have Microsoft down 3.1%. Off of its lows, though, a good quarter in some ways, but lots of focus on the deceleration on the cloud unit. We'll be taking a look at them in a moment. I wouldn't be surprised, though, if this is seen as sort of a clearing of the deck and that maybe you're going to see this stock re-rated, valuations relatively attractive to growth. Texas Instruments, not a great quarter, down 2%. Boeing, a similar picture. Their outlook also disappointing. AT&T really an outlier. Their outlook, especially relative to free cash flow, sending that stock higher, up by 6%. What is sending Microsoft down at this point? Because initially, Microsoft yesterday in the aftermarket, it was higher on the cloud business. But now if we take a deeper look at the cloud business, what investors are concerned about is this deceleration of growth that we do see for Azure, expected to be 33% revenue growth for this quarter, down from about 48%. Their fiscal first quarter is the September quarter of 2021. So it's that deceleration. Although on the other hand, Guy, you did have Satya Nadella last week at Davos talking, the CEO of the company, talking about the idea that the pandemic created that boost. Now we're seeing a normalization. What level will investors accept as the new normal? I guess we're finding that out.
Well, yeah, it was interesting. It was on the call that I think that message kind of dropped, and you could see the stock reaction really clearly. Abigail, thank you very much indeed. That came after hours, of course. Where are we? 7:32 on the West Coast. Time for the startup. Top tech stories from the Bay Area and beyond. Silicon Valley starting its morning. A lot to think about as it does so. Joining us now, Bloomberg Technology editor, anchor, co-anchor even, Ed Ludlow. You'd think I could be able to read that. It's early.
Is
It's
it?
not. It's late for me. It's early for you. I'm going to take that. Ed, lots to talk about here. Look, I think the cloud question is really interesting. We've got to talk about Tesla. We've got to talk about Azure as well. There clearly was a boost during the pandemic, but everybody thought that we, with cloud, were going to the moon. Are we getting an idea now that that is now no longer the case? And do we have a clear idea about where ultimately the growth rate is going to settle? I'm assuming it's going to be lower, but kind of what that number looks like.
Yeah, I mean, Abby was talking about it earlier, right? The initial sort of joyous reaction in after hours, and then what we're seeing in the stock right now. You know, the initial jump was because Azure fared better than expected in the final 3 months of last year, which was its fiscal second quarter. But actually, the outlook shows, just like everything else, there is a slowdown in business spending, commercial demand. And Amy Hood quantified that, the CFO of Microsoft, saying actually sequentially we'll see a drop of 4 to 5 points for the fiscal third quarter from the fiscal second quarter. What's really interesting is this idea that the action they're taking is a little bit incongruous with what you see on your screens. That's basically how they're going to perform financially. But what's really interesting, Azure is a cloud platform, and Microsoft is still committed to investing from a CapEx, OpEx perspective on data centers, because they still see this is a long-term story around cloud. There are businesses out there that need to move from their legacy infrastructure to the cloud, and they're going to make sure they have the right infrastructure to do that themselves.
So Ed, where do they think that the cloud revenue is going to end up being? Like, what's the longer-term trajectory? Like, gains were in the mid-30s, okay, it was better than expected.
Yeah.
They're going to go down by 4 to 5 points. Like, where does it base?
It's all relative, right?
Yeah.
You know, 4 to 5 points drop and you're still at mid-30s. The problem is that it's the saving grace when every other part of the business is slowing down. And there was one headline that crossed the Bloomberg terminal. You know, I don't know if you guys kind of go straight to this when earnings drop, but there was sort of no clear full-year guide from Microsoft. But on the call, they talked about growth in the commercial business will slow for the full year. And I think the idea is that we don't know necessarily where revenue goes. All we got from the commentary on the earnings call is that it's a downward trajectory. And why are we sitting here talking about Microsoft and its clouds business? And, well, they went first, right? They were the first name in earnings to report. You know, we saw their first sell rating in years before earnings, and this idea that they are not immune to the global macro headwinds we're seeing, and that proves completely true. And what you're seeing on your screen is what it sort of typifies this entire earnings season for big tech, a massive drop-off in earnings and profit.
Ed, let's turn to your favorite subject, Tesla. We're going to talk to analysts in just a moment about what is happening here. what are you expecting? Where's the focus going to be for Tesla this quarter? Is it going to be on what the demand outlook is right now, or is it going to be on how they're managing costs, how they're managing production, what the margin line is going to look like? Where should we be looking?
Yeah, demand and profit, because they're linked, right? I think analysts expecting adjusted earnings of $1.12 per share on around $24 billion of revenue. For Tesla, that's still sequential and year-on-year growth in a really big way. They're coming off another record quarter of deliveries, even though those were below estimates. Analysts go straight to gross margin, right? Because Tesla's gross margins are better than anyone else in the auto industry comparatively. The price cuts that we saw in China and the United States are going to impact gross margin. Analysts see that coming in at around 25%. So that is the question, right? How do you continue to maintain volume growth? Do you cut prices to kind of initiate some demand for unit or volume growth without sort of impacting the bottom line too much? And this is the thing, like, we're all excited about Elon Musk, we're all excited about the sort of big weight of expectation around Tesla and this big character, but often in earnings season it's Zach Kirkhorn, the CFO, who steals the show, because he's sort of a very normal, prudent, straight-talking chief financial officer who gives granular detail about what Tesla is doing to protect its bottom line and also what the headwinds are to the bottom line. It's boring and old school stuff, but I love it.
We know. That's why we love you. Ed, we also got some two Wall Street analysts lowering their price target on the company right ahead of earnings. It hasn't had necessarily a good run. I mean, it's up a little bit from its bottom, but it hasn't had a great run into earnings, and I'm just wondering how that positions the stock.
Yeah, so I mean, I think we're up something like 15% year to date right now. I'm just pulling up the stock as we speak in this moment in the session, and we are down 3%, but we're up 15% year to date. You know, not that many days in January so far. Tesla is coming off its worst annual decline ever, right? The stock dropped 65%, and this is a broader discussion around technology. You know, you go from worst to first. Some of these are the most downtrodden stocks on the NASDAQ 100 or the S&P 500, and buyers have come back in at the new year. But earnings really refocuses us on the fundamentals.
All right, Ed, love it. We'll look forward to all of this later on in the show, later on today.